Oh, right. Chapter 14. Here we are. So, partnerships. The rules for partnerships can be kind of tricky. We kind of address it in this chapter at the 30,000 foot level. But just know that partnerships, and when I was in school, in graduate school, partnerships had their own class. The whole thing was partnerships. So it can get kind of tricky. And I'll point out the parts that most students kind of struggle with regard to partnerships, and we'll try and spend a little bit more time on those items. So we've got 6 learning objectives here. First one, we're going to talk about how partnerships are formed. So both from a tax perspective and a little bit from a legal perspective. The legal perspective is pretty short. Then we're going to talk about, now there are different types. Remember we looked at chapter 8 and we talked about flow-through income. Partnerships are a type of flow-through entity. So the partnership itself does not pay tax. They have to report all of their income and expenses, and all those income and expense items then flow through to the owners or the partners in the partnership. And then the partners pay tax at their own tax rate. And if you recall, we also had, we looked at the K1. The K1 is the form that partnership income and expenses are reported on. And we've got lots and lots of different boxes because all of the income from the partnership retains its character as it flows through to the partner's tax return. So if it's a capital gain, long-term capital gain to the partnership, it's a long-term capital gain to the partner. If it's rental income to the partnership, it's rental income to the partner. And so we've got to separate out all of those different types of income as well as credits. But we also have just the ordinary income or loss from the partnership. That is essentially the net income. If you think of the Schedule C, line 31, that the taxpayer pays tax on if they're a sole proprietorship, this is the equivalent of that line 31 on the Schedule C, except it's from a partnership, right? So that's the net income from the actual operations of the partnership. Those other items that I talked about, the capital gains and losses, the rental income, all that separate stuff, the qualified dividends, those are all of our separately stated items. We already talked a lot about that in chapter 8, but we're going to revisit it a little bit. Probably the most difficult concept in this chapter is the whole concept of basis. We already talked about basis in chapter 7 when we were looking at capital gains and capital losses and sales of different types of assets, right? Remember, we needed to know what the basis was in each of those items so that once we sold them, we could calculate our gain or loss. So we need to know basis for partnerships for a similar reason. If we dispose of our partnership interest, we have a gain or a loss to calculate. But there's another reason that we need to know about basis, and that is to determine whether or not any distributions that we receive from the partnership, and that by distribution I mean if the partnership pays the partner cash or gives the partner some sort of asset, that is like a return of whatever's been invested in the partnership. So think of it like, well, it's kind of hard to think of an equivalent with regard to different other types of investments. Well, sometimes they have return of capital. If you have purchased stock, maybe you purchased some public stock, and the company decides that you've given them some money to invest, you've got 10 shares of stock, and they decide they're going to return some of those shares to you, right? So when you bought it, that was already income that was already taxed when you purchased it. So getting it back, you're just getting back your own money, right? If you think about, actually a bank account's probably a better example. When you deposit money into a bank, you're just depositing your own money into that bank, right? When you get it out, you're just getting back your own money, what you already put in. You're not going to be taxed on any withdrawals that you have because that was your money in the first place. Partnership is the basis of a partnership is sort of the same. It's the amount that you've contributed to the partnership, and then when you get the funds out of the partnership, you're just getting your own money back, right? However, if you start to get amounts back from the partnership that you never contributed in the first place, now that becomes income, right? So if you were to, bank accounts don't do that. Well, they will give you overdraft, but then they charge you all sorts of fees for it. But once you take out more than what you initially put in over the years, then the nature of that distribution changes, and how it's treated for tax purposes changes. So this is why we need to know what our basis is in the partnership. It is a continuous calculation for as long as the partner owns the partnership. It is a running tally. Okay, so we're going to spend quite a bit of time talking about basis. Partnership distributions. This is related to basis, right? If we're getting something out of the partnership, and that could be cash, that could be some piece of property, it could be any other type of asset. If we're getting something out of the partnership, we need to know, that's called a distribution. We need to know how that distribution is going to be treated for tax purposes. Is it just a return of what we already put in? Or is it over and above what we've already put in, and therefore it may be some type of gain that we get on the partnership? And then lastly, we're going to talk about what happens when we liquidate a partnership or when we dispose of a partnership interest. Okay? What we're going to start out with, though, is this is kind of the life cycle of a partnership. We're going to start out with the formation of that partnership. Okay? Questions before we get into it? It's very different from individual taxation. Okay? So